My whole career has been about money. I have several degrees in accounting, finance, and law, and for more than a decade, I have advised companies on investment strategies, tax minimization, asset purchasing and leveraging, and business structuring, all done in the name of maximizing revenue and profits. That's my whole job. That's my specialty. And in doing so, I've gained a lot, especially by being around wealthy people and understanding their mindset on how they have been able to accumulate and build up their wealth. And by doing so, I've honestly learned so much, especially about my own personal bad money habits. And on this video, I want to extrapolate these learnings and tell you about the 9 money habits that are keeping you, and perhaps I, poor.
Back in that bag again. Whoa, yeah.
The biggest thing keeping you poor is lifestyle creep. For those of you who don't know lifestyle creep or lifestyle inflation, well, it refers to the gradual increase in one's standard of living as their income rises. This is when you start purchasing non-essential items, and that's when you start upgrading your lifestyle, say with a new car, with a new bag, or a new house. And look, I'm gonna have to confess, I have been a victim of this myself. You see, when you start making more money, say you've received a new promotion or you've upskilled yourself with tertiary education, for example, an MBA or a JD, you are now in a higher position. And you inevitably surround yourself with other people of the same caliber as you, especially when it comes to your workplace. Being a manager is a great example, or say, being a partner at a law firm or a managing director at an investment bank. With these later two especially, there's a lot of pretentiousness. I'm gonna have to be honest, and I'm allowed to say it. Look, every time we have Friday night drinks, there's always 2 discussions. One is about watches, and the other one is about cars. And that's when we either start flexing or we start envying. And look, there is a fun and games component to this, but there's also a very real, serious issue behind this. Because peer pressure does exist. And just because you're a fancy lawyer or a fancy banker does not mean that you're not susceptible to peer pressure. Especially when lavish spending is part and parcel of one occupation. And the consequence of this peer pressure is spending more than you can afford. And I would even say it's just spending more in general, period. Just spending more money. You see, when it comes to personal wealth, there's 2 variable components. One is income, and the other is expense. And this is a basis of the profit and loss statement. But one thing I've noticed about human psychology is that we tend to focus on what we can add to our stockpile instead of seeing what we can reduce. And this is a reason why there's a phenomenon in this day of age of side hustles and how to make extra money instead of focusing on how we can reduce our current expenses. And this is a reason why lifestyle inflation is the biggest thing keeping you poor. Is that by curbing your lifestyle inflation, you can save so much money. And we're not just talking about saving on the big ticket items. It's also about these small little things. For example, now that you've got a higher salary, maybe you're willing to pay extra for these things you've never really dreamt spending money on. Maybe you're going to upgrade to a nicer suite on your next holiday. Maybe when you go out to eat, you're going to spend more on that expensive steak option. A surf and turf. Maybe you're going to spend more on that expensive, concert ticket for Taylor Swift, because why not? The problem is, now you are accustomed to it. What was once an innocent once-off purchase is now a thing that you cannot live without. It becomes a necessity. And what does that mean? Well, now you need to start earning more money to pay for these extra expenses, and the cycle continues. And if we go back to the profit and loss statement and we do a comparison, if someone is making $100,000 a year and someone else is making $80,000 a year, and then we have another person making $80,000 a year, but they're only spending $40,000 a year, who's better off? This is the reason why so many people with high paying occupations are up to their necks in debt compared to other people who have more moderate levels of income. And it's also the reason why people who are actually rich look poor and people who are actually poor look rich. And I want you to really think about that. And look, the theory behind all of this sounds very simple. It's in practical terms, guess what? It actually isn't. And that's because there's a huge psychological barrier which people have to face, as well as dealing with societal expectations and workplace culture. But I guarantee that if you sound strong and you are disciplined, you will be able to become wealthy if you stay in your own financial lane. The second thing is not having a budget and not being aware of your expenses. What I've noticed about most people is that no one really keeps track of their ingoings or outgoings. Everyone kind of has this hunch and it's based on feel.
Just use feeling.
Now, look, with your ingoings, well, it's pretty easy for most people because most people have a single source of income and that's paid fortnightly or weekly or monthly, and that's generally after tax. It's really the expenses which matter. And I want you to look at two types of expenses. You've got your essential expenses and you've got your discretionary expenses. Essential expenses are your groceries, it's your car petrol, it's your medical costs, it's your utility costs. These are things that you need. And then we have your discretionary costs. These are your non-essential costs. Not only will these cover concert tickets, outside dining, but also small things such as buying coffee. And guess what? Buying coffee, it adds up. And look, there's going to be some variability between different people as to what they categorize as being essential and not. Regardless, what you need to know is what you're actually spending your money on. And again, this goes back to my comment about the profit and loss statement and how people really need to consider curbing their expenses. Instead of focusing your income, I reckon you should focus your own expenses because you will see you'll end up making more for your quote-unquote income when you reduce your expenses than this idea of a side hustle. But we'll get to that in another video. Now, you can obviously solve this by a simple budget. You don't have to have a expensive budget, and you definitely don't need to sign up to some kind of app or purchase this expensive software. In fact, if you really want, let me know in the comment section below because I can show you how I budget. And if you can't do it yourself on Excel, I'm more than happy to just send you my own budget spreadsheet for free. And if you really want it, just let me know down in the comment section below. So once you have this budget or you've made your own budget, you can start filtering things out. So you may recognize a subscription that you don't really use, or maybe you have a recurring expense which you don't really need, but when you add it all up, it's a lot of money. And that's when you can start cutting down your expenses. That's when you start saving money. And after all of this, you can actually see how much you're actually spending per month. And that's how you budget. And I'm going to tell you this. People who are actually rich know exactly where their money is. They know how to budget. So why don't you? Now, number 3, that's when we start getting excited. This is where things start getting juicy. Number 3 is pay yourself first. Now, this concept comes from a man called George S. Carlson, and he wrote a book called The Richest Man in Babylon. And this book summarized a collection of parables from ancient Babylon surrounding personal finance and financial literacy, with the main idea that you should live below your means and you should save, and then using your savings you can invest and produce passive income. Now, the idea of paying yourself essentially means that when you receive a salary, you should take a percentage and put it directly in your savings. And then with the rest of the money, you should allocate it to your expenses. So the theory is that because you have a lower pool of money to work with, you will be more intentional with your money and you'll be forced to be more frugal. And this idea is great because it really hits on the first few lessons that we've talked about, especially lifestyle creep. Lifestyle creep occurs because you have more money and therefore you'll spend more if you have more. But if you immediately put at least 10% of your gross monthly income into a savings account, well, now you only have 90% of your gross monthly income to spend. And this creates a situation where you are forced to spend. Now, I already know what you guys are going to say. You're going to say, Raph, this means that I'll be living paycheck to paycheck. Well, exactly. That's the whole point. You need to start living paycheck to paycheck. You are going to be way more careful purchasing that extra coffee from Starbucks now that you've got less money to work with. So when you start double thinking, thinking again about that extra dress, that extra gadget, that extra toy, guess what? That's going to retrain your mind. And then while your mind retrains, you will have the comfort of knowing that you have money saved away. And if you put it in a high interest savings account, then not only are you saving money, you're actually making money. This is going to be very controversial on YouTube because YouTube is filled with personal finance gurus who have no qualifications, no professional experience, and no ethical standing. All they have is a phone, a tripod, and a bad haircut. I said it. And this pisses me off because they always recommend that people have debt, credit card debt, personal loans, business loans. Having credit card and having loans is a very dangerous road that you should only go down when you are capable and disciplined. Now, what are the factual bases of these type of short-term loans? Well, they give you quick access to capital, often in the thousands. They're often relatively cheap and easy to obtain, depending on your jurisdiction. And they sometimes have these reward schemes. So it might be a frequent flyer reward scheme or a cashback. And they also have this really amazing thing. It's a great feature. It's called a crazy high interest rate. And this is the bummer. See, no one ever gives out money for free. Do you really think that credit card companies are going to hand you free cash and free plane tickets? What tends to happen is that people again focus on income and they think, how can I maximize my money? And these are people who are very early in their personal finance journey. And instead of focusing on their expenses, they focus on how they can get the best bang for their buck with their expenses. So they look at credit cards and they see these points and they're like, wow, I can actually use my credit card to pay for these expenses and get these points. And at the beginning, it's great. But because they have such a high credit limit, they spend more than they can service, and they eventually have credit card debt. And I mentioned this before as a perk of credit cards, and that is a high interest rate. So Bill and Ben, the flower pot men, end up losing their money because they have a crazy high credit card interest rate. And it gets worse if you have a personal loan. Look, I know credit cards are enticing and I do recommend them, but I'm very cautious when I recommend them because I've seen too many people fall and fail when it comes to having credit cards. And I don't want to start a dialogue with loans, especially business loans. We can talk about that another time. So I really believe that you should focus on not relying on debt, focus on being debt free. And then once you've developed a routine, you can start to explore the benefits of credit cards. A rainy day fund is a proverbial term for an emergency fund. This is when you're not able to receive your normal income because of injury, illness, changing jobs, or because of unforeseen circumstances. And it really ties back to everything that we've talked about in terms of reducing our expenses, putting money aside for savings, and not having debt and therefore not having liability. And again, everything that we've talked about, they tie together. They really work holistically. And a lot of these habits, it's to really pay for a rainy day. And don't think you're superior when it comes to the idea of a rainy day. Look, it happens to anyone. It doesn't matter who you are. Bad things happen. And sometimes the bad things are good things, but regardless, you need to have a rainy day fund. And guess what? If you follow the tips that I've actually recommended, then you will have money for this rainy day funds and you can actually spend money for these kind of situations. So I guess the question is, how much should you actually save? Generally, the recommendation is 3 to 6 months, and certainly more if you can. And I should also say it should include your mortgage, should include your children's school fees, all those things that you classify as being essential. The sixth lesson is it really requires its own video. Now, look, I've worked in corporate tax, individual tax, and transfer pricing. I know tax. In fact, I've actually made a video about how companies avoid tax, which I will link down below. But a lot of people don't understand the tax system. And to be quite flippant, I don't think you really need to, because the deductions that these YouTube gurus talk about are not really available to the majority of people. And that's because the majority of people have single jobs where they earn a single income that is often taxed under the pay-as-you-go tax system. This means the tax is already accounted for when you get paid. In fact, what you get paid is your after-tax income. Now, in Australia, our tax system is actually pretty good. I know that might sound surprising to many people in Australia, but it's actually pretty good, especially when you compare it to the US. Now, for example, in Australia, your employer is required to take a portion of your income and put it into your superannuation. This is your retirement fund, and this is what you can access when you finally retire.
Retirement?
In the US, superannuation is called the 401k, and depending on your state, you might need to actually tell your employer to make these contributions. Now, there are some strategies you can be involved with and explore. For example, you can make extra superannuation contributions, which will be taxed at a much lower rate than your pay-as-you-go income tax rate. And look, you can research and see what deductions are available to you, thereby reducing the amount of tax you end up paying. And look, there are several categories of deductions that may likely be available and applicable to you. And of course, if you are game, then you can go and start your own company and start looking at business expenses. But I warn you, I hate YouTube personal finance gurus for this, because it's not a simple process of let's start a company. You have to be incredibly careful. You have to be incredibly diligent. And quite frankly, you need professional advice. Please seek professional advice before you start a company and before you start making these company deductions. Don't ever forget, nothing in life is free. So if you're thinking you're going to be making these massive deductions, you're getting this supercar, what you're actually getting is a jail cell. And then you can contact me and I can represent you for $1,000 an hour. This is what YouTube influencers don't want you to know. So please take what I'm saying to heart, and please don't follow these YouTube influencers. This seventh lesson pays homage to what we've already been talking about, and that is reducing. And the reason why I'm making this a separate topic is that even though you are getting a promotion or a pay rise, we are more and more enticed to spend money. Advertising is through the roof, and we're getting text messages every waking day of our lives. We're getting bombarded with spam calls and emails. Look, businesses are constantly wanting to sell us things. And these marketing tactics are very smart because they make us feel that we are without. It's like we've been missing this missing puzzle for our whole life. But we're actually not. These are just sale tactics. And again, it's a psychological thing, which means that if you have discipline, and guess what? If you have discipline, then you won't be affected by these sale tactics. So it's a very simple lesson, but it means a lot. Again, have that discipline. The eighth lesson will save you money in the long term. Learn the difference between being frugal and being cheap. They're not the same thing. Look, whilst being frugal and being cheap means that you want to save the money and save the most money you can, and theoretically that would mean that you want the cheapest thing, being frugal actually looks at the lifespan of the product and compares the effectiveness of the product against the cost. Meanwhile, being cheap means that you simply want the cheapest outlay today, notwithstanding the effectiveness long term. Let's let's look at an example. How about a jacket? So you can buy a cheap jacket, or you can buy a medium quality jacket, or maybe you can buy a very expensive jacket. And truth be told, normally there isn't a 3-tier option. It's normally there's multiple options and there's nuances, etc. But let's just look at 3-tier option. So for a person who buys the cheapest option, they will inevitably get a jacket, which is low quality. It lacks weatherproofing. It doesn't retain heat. It's made out of fine and delicate material, which means it will, easily tear and get damaged. It's also probably not made out of material that withstand changing temperatures or, changing terrain. However, it's cheap. The problem is that whilst it may work in the short term, it doesn't necessarily last in the long term. So after a year of wearing it, it breaks down, and then guess what? You have to purchase a new one. So what's the point of all this? And that's the irony, of course, because now you're spending twice the amount of money paying for this cheap jacket, even though you could have purchased a slightly more expensive jacket that would have lasted multiple winters. And look, this applies to many things in life. For example, hiring a cheap accountant or a lawyer, you get what you pay for. And most people, they unfortunately have to go through this lesson in life until they finally realize this. In fact, this lesson actually stems from the boot theory. And this is an economic theory that people in poverty, they often buy cheaper and subpar products that need to be replaced repeatedly. Whereas rich people, they purchase more expensive products, but they last a lifetime. And in the long term, they end up paying a cheaper and lower price. And it really speaks strongly to me because I am Australian and I love to wear my RM William boots. But look, this is not an advertisement. What you need to really learn is that cheap isn't necessarily cheap. You don't necessarily have to choose the best and most expensive option, but you need to choose the option that actually lasts. The 9th and final lesson is that you need to have a plan. Look, let's be honest. In every other part of your life, you have a plan. If you're going on holiday, you've got an itinerary. If you're going fishing, which I love to do, you know where you want to fish. You know what bait to have. You know what rig to tie you up. Heck, when you're planning your career, you will plan what to study, where to study, what you want to do for work, and what position you want to reach. So why is it that you're planning for every little part of your life but your finances? You really need to have a strong grasp of what you have and what you can earn and where you want to be. Look, not everyone wants to be a multi-millionaire with a Porsche 911 and a massive yacht. In fact, most people don't want that. Someone who makes people money for a living, money doesn't buy happiness, and believe it or not, the rich actually know this. This isn't just a poor concept. The rich know this. And for most people, they actually want the basics, and that is what makes them happy, and that's what makes them content. But even for the basics, you need to have a plan. When you consider the economy, inflation, the employment rates, things are not as rosy as you may assume or even hope. And therefore, having a strong financial plan it's literally everything. So these are just 9 of the habits which keep you poor, and certainly things that have kept me poor for a long period of time. As I said before, just because you earn a lot of money doesn't necessarily mean that you are wealthy. So I think these lessons apply to everyone, and I really want to know what lessons really speak out to you. Let me know down in the comment section below, and also let me know what are some habits that you feel strongly about that should be done or shouldn't be done. Again, let me know down in the comment section below. But thank you so much for watching this video, and I will see you on the next one.
Back in that bag again. Whoa.